Good morning, children. Today in commerce, I will be taking the next subtopic of your chapter Sources of Finance in a Joint Stock Company. Till equity shares I had already taught you. Now today I will be taking the next heading, that is preference shares. Now beginning with the meaning of preference shares. As yesterday I taught you that equity shares do not have any preferential right, but when we go through preference shares they have preferential rights. Now what are the preferential rights? I'll teach you. Preference shares are those shares which carry certain preferential and priority rights. What is it? The dividend at a fixed rate is payable to these shares before any dividend is paid on equity shares. This is a priority which is being given to the preference shareholders. The preference shareholders, they have got the right that the dividend will be payable to them first, then to equity shares. This is the first priority. Second priority, at the time of winding up, the company capital is repaid to preference shareholder prior to the return of equity shares. So, when the company is going to wind up, then too, whatever is the share capital invested by the preference shareholders, they have got the priority to get the return of that share capital before equity. Alright. So, preference shares have some preferential rights, and these are the two preferential rights which are priority rights which is being paid or which is being given to preference shareholders. But there are certain disadvantages. That one disadvantage I'll let you know, that these preference shareholders, they do not carry any kind of voting rights. These holders of preference shareholders may claim voting rights if the dividends are not paid for 2 years or more on cumulative preference share. This is the condition. So, preference shares have the characteristics of both equity shares as well as of debentures also. Now, like equity shares, dividend on preference shares is payable only when there are profit according to the term of issue. But preference shares are similar to debentures in sense that the rate of dividend is fixed and preference shareholders do not generally enjoy the voting right. That is why they are not being considered as preference. They have some quality of debentures also. I hope so it is clear. Now moving ahead, the types of preference shares. This is there in your syllabus, so I'll explain you. The very first type is cumulative and non-cumulative. Cumulative as a word only decide that something gets accumulated. Alright, and what is that something which is accumulating? That is dividend. When the dividend go on accumulating, if they are not being paid, preference shares are said to be cumulative. If due to some reason dividend in a particular year or has not been paid, they will get carry forward to the next year. Such unpaid dividends go on accumulating and become payable out of profit in subsequent year. And these kind of shares which have got these preferences, they are considered as cumulative preference share. Non-cumulative, in this category, the second one is non-cumulative preference share. In this type of preference share, dividend is unpaid. Alright, dividend if unpaid, they are not being carried forward. I am again repeating, if the dividend is unpaid, they are not being carried forward. They do not accumulate. If the company is unable to pay the dividend in a year, then the shareholder right of dividend in respect of that year is lost forever. That means the shareholder do not demand for the dividend. Then the next is participating preference share. These preference share, they carry the right to share in the surplus profit left after a fixed dividend is paid on both equity and preference share. Non-participating preference share, these are the shares which carry a right on only a fixed rate of dividend. Do not give their holders a right to share in residual profit. Then the next category is convertible and non-convertible. Now, convertible preference shares. Convertible preference shares, when we talk about convertible preference shares, are the shares which are given the option to convert these shares into equity rights after a fixed period of time. And non-convertible preference shares, if we talk about, that these are the shares which are not being convertible into equity shares. Now, redeemable and irredeemable preference share. When we talk about redeemable preference shares, are those shares which can be refunded either on expiry of the specified period or at the option of company. The Company Act has laid down that preference shares must be payable within 20 years from the date of issue. And irredeemable, such shares are not refunded, are refunded only at the time of winding up. During the lifetime it has not been refunded, but it is refunded only at the time of when the company is going to close down. This much is clear. Now moving ahead to the next topic, that is advantages and disadvantages of preference shares. Now, the very first is from company's point of view. In the company's point of view, the very first it says appeal to cautious investors. Now, in appeal, preference shares can easily be sold to investors who prefer reasonable safety of their capital and want a regular and a fixed return on it. Alright. Then, no burden on profit. Preference shares, they do not put a fixed burden on finances, as dividends are payable only out of profit. So dividend is only being paid out of profit, so there is no such foundation or no such burden on it. Then the next is no interference in management. Preference share do not carry any voting power, so that is why they couldn't participate in the decision making of the enterprise. A company can raise capital without dilution of control. Equity shareholders can retain exclusive control, not preference. Alright. Then trading on equity. This means that the rate of dividend on preference share is fixed. Therefore, with the rise in its earning, the company can provide the benefit of trading on equity to equity shareholders only. Then the next is flexibility. A company can issue redeemable preference shares for a fixed period. The capital can be paid on equity shares only. Alright. The capital can be repaid when it is no longer required in business. Alright. There is no danger of overcapitalization and capital structure remain elastic. This is about the flexibility. Now, the advantages from the point of view of investors like shareholders and all. Now, investors get a more stable and regular dividend before payment of equity. This is the benefit they get. Then the risk involved is comparatively less because preference share capital is payable before equity shares. Thirdly, preference shareholders can expect to get back their investment after a certain time period. Alright. But preference shares cannot be issued for a period of more than 20 years. Only there is a limit. For 20 years, these kinds of shares are being issued. In case of cumulative preference share, the arrears of dividend also accumulate and it is payable in future. This is a benefit they get. The cumulative preference share get this kind of benefit. Now moving ahead, the next is from the point disadvantages from the point of view of a company. Now the very first which is there, that is costly. costly resource. The cost of raising finance through preference share is greater than that of debentures. Preference dividend is not deductible for taxes purposes. Alright. Then the next is permanent burden is there. Now when we talk about of permanent burden, it says that dividend on preference shares has to be paid at a fixed rate before any dividend is paid on equity shares. Alright, there is a fixed rate of dividend to be paid to the preference shareholders before the dividend is paid to equity shares. This is the priority right which the preference shareholders get. Then next it says legal formalities. When we talk about of legal formalities, there are various kinds of legal formalities for redemption of preference shares. Alright, then next is law appeal. In law appeal, or you can say limited appeal, bold investors do not like preference shares. Cautious and conservative investors prefer debentures and government securities. Alright, so this was about law appeal. Now from the viewpoint of shareholders, the very first point it says lack of voting right. Preference shareholders, they do not get the voting powers. Alright, this is a drawback. The preference shareholder do not carry any kind of voting power in the company. That is why they couldn't participate in the decision making or any decision policies of the business. Then next it says fear of being shown the door. Holders of redeemable preference shares to face yet another unpleasant prospect. This is one of the drawback. Then no capital appreciation. Preference shareholder do not get any return on their capital. Alright, they do not get any appreciation on the capital which they have invested. Then the next it says no guarantee of dividend. Payment of dividend on preference share is not at all guaranteed. Rate of dividend is generally modest and price fluctuates of preference shares is greater than that of debentures. So this was about the disadvantages of preference shareholder. In your book only, children, there is the distinction being given, distinction between equity shares and preference shares. You have to go through that distinction in the same tabular form. Children, you have to learn all the points of your book. Do not leave any of the point, because in class 12 the syllabus is much more modest and elaborated. So you have to, as I taught you in class 11, that each and every point in your book is important. So all the points you have to write in your answers. Alright, so this is all for today. Rest, we'll continue tomorrow.